Hello everyone, welcome back to Fundrise Finance. I know I keep repeating the same thing, but nothing has changed. The stock market ride this year so far has been very wild. At times, it feels like investing into this market is waste of time, money, and effort. The S&P 500 so far this year is down 14.5%. The Nasdaq has fared much worse, down more than 24%, and the ever so stable Dow Jones is down more than 10%. So yes, the question is very common that why should one invest in times when there is no certainty about anything in the market? You never know when from which corner of the market bad news may come and takes down everything. So the fear of market correction keeps many away from investing. This is where the quote from the legendary investor Peter Lynch comes to mind. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. That quote makes so much sense. If you see the last 1 month itself, almost till May 20th, the market was just going down and down and down. If everyone had just given up in the hope of investing, they would have lost the wonderful rally which we had of almost 7% towards the end of the month. So if we pick good companies and just keep investing into them, no matter what the market is doing, in fact, if the market is down, you'll be getting more shares of the company that you love so much. And if you're able to buy that company stock at a very low price, that's wonderful. Because once the price starts going back up, the market is going back up, you are in the profit. So, like as I do every start of the month, in this video, I want to call out five such good stocks which are at very good valuations at this moment, and we should not miss the opportunity to buy them. Let's check it out. And if you like such content, please subscribe to my channel and hit that bell icon so that you don't miss a single video packed with valuable information just like this one and help grow this young channel. But before going further, let's take a look at how the stock picks for the month of May has been performing so far. Here we had Pinnacle West, Air Products and Chemicals, Store Capital, Texas Instruments, and Goldman Sachs. In the last 1 month, barring Store Capital, every other stock has performed in the green. Store Capital has underperformed by more than 3%. Texas Instruments is given 22.45%. After that, we get Air Products at over 4%, Goldman Sachs 5.36%, and Pinnacle West the best performer, giving almost 9% returns in the last 1 month. So almost all of them have done really good in the last month, thanks to the rally that I spoke just a while back. In fact, even after this rally, a few of these are still at a very good buy points, giving us great valuation. So I have included a couple of these into my stock picks for the month of June also. To know what they are, stay tuned until the end of this video. So let's get started. First on the list we have Starbucks Corporation, ticker symbol SBUX. Starbucks, as we all know, is a worldwide retailer of specialty coffee, and the stock has taken a real beating year to date, down almost 35%. In the last 1 year, Starbucks has fallen almost 33%. Starbucks has a market cap of almost $88 billion, giving a yield of 2.57% and having a PE of 26.5. Looking at the dividends, Starbucks has been raising its dividends for the last 12 years at a 5-year dividend growth rate of 15.11%, which is almost double that of the current inflation of 8.5%, which is really good. The payout ratio is tad higher of almost 58%. As per TipRanks, Starbucks has an upside of 24.6% with a target price of over $95. Tracker Dividends gives Starbucks a dividend score of 80 and considers it undervalued by 40% with a fair price of $127.31. But as per my dividend calculations, which considers the average dividend yield over the past 5 years and the current yield, I calculated Starbucks to be undervalued by 14% with a fair value of $87. So averaging these three numbers, we get a fair value of $103. That makes Starbucks 35% undervalued. The second stock on our list is Union Pacific Corporation, ticker symbol UNP, which is a railroad operator in the United States. Year to date, Union Pacific has fallen almost 11%. In the last 1 year, it's down 1.65%, and last 5 years, it has returned over 99%. Union Pacific has a market cap of almost $140 billion and it currently yields 2.35% at a PE of 18.92. From a dividend standpoint, Union Pacific has been raising its dividends for the last 6 years at a 5-year growth rate of almost 15%, with a payout ratio of almost 43%. So the 5-year growth is really good. It's much more than the current inflation. Union Pacific has also raised its dividend by 10%, which was announced last month, which is really good because the latest dividend increase is also keeping up with the inflation. As per tip ranks, Union Pacific is a moderate buy with an upside of almost 23%, with a price target of almost $272. Tracker Dividends gives Union Pacific a dividend score of 54 and considers it undervalued by almost a percent, with a fair price of $222.56. But as per my calculations, I found Union Pacific to be undervalued by 16% with a fair price of $257. Averaging all three numbers, we get an average price of $250.45, which makes Union Pacific undervalued by 13%. The third stock on our list is Stoke Capital Corporation, ticker symbol STOR. Stoke Capital is from the real estate sector. It's a REIT, which is a real estate investment trust, and it specializes in the management of single tenant operational real estate. Year-to-date, Stoke Capital has fallen more than 20%. It has a market cap of $7.64 billion and currently has a yield of 5.6%. Stoke Capital has been raising its dividends for the last 7 years with a 5-year growth rate of 5.85%. So it has a high payout ratio, as does many of the REITs, because they are designed in such a way that they have to pay out most of their profits back to their shareholders. TipRanks considers Stoke Capital a moderate buy, with an upside of almost 22% and a price target of $33.50. Tracker Dividends gives Stoke Capital a dividend score of 49 and considers it undervalued by almost 17% with an estimated price of $33. But as per my calculations, I found Stoke Capital to be undervalued by 19% with a fair value of $33. Averaging all three numbers, we get an average price of $33.16. That makes Stoke Capital undervalued by 20.5%. The fourth stock on our list is Medtronic PLC, ticker symbol MDT. Medtronic was also in our May stock list, and year to date it has fallen almost 8%. Medtronic has a market cap of almost $132 billion and currently has a yield of 2.78% with a PE ratio of 17.57. From a dividend standpoint, Medtronic has been raising its dividends for the last 43 years, so that makes it a dividend aristocrat. The 5-year growth rate is almost 8%. The payout ratio is really good, less than 45%. As per TipRanks, it considers Medtronic to have an upside of almost 18% with the price target of $115. Tracker Dividends gives Medtronic a dividend score of 80 and considers it undervalued by 18.55%, the fair value of $120. But as per my calculations, I found Medtronic to be undervalued by 25% with a fair value of $122. Averaging the three numbers, we get a price of $119. That makes Medtronic undervalued by 21.7%. The last stock on our list is Goldman Sachs, ticker symbol GS. Goldman Sachs was also part of our May stock list. Year to date, Goldman Sachs has fallen almost 19%. There's a market cap of almost $108 billion and currently has a yield of 2.49% with a PE of 8.52. From a dividend standpoint, Seeking Alpha shows Goldman Sachs to be growing its dividend for just 1 year, but I think this is incorrect. It has been growing it for the last 10 years. The 5-year growth rate has been really good at 24.26% at a very low payout ratio of just over 14%. TipRanks considers Goldman Sachs to be having more than 30% upside with an average price target of more than $419. Tracker Dividends gives Goldman Sachs a dividend score of 78 and considers it undervalued by 38.55% with a fair value of $523.76. As per my calculations, I found Goldman Sachs to be undervalued by 29% with a fair value of $415. Averaging the three numbers are, we get an average price of $452.66. That makes Goldman Sachs undervalued by 40.64%. To summarize all the stocks we just discussed, we have Medtronic, Goldman Sachs, Starbucks, Stoke Capital, and Union Pacific. So I consider all these five stocks to be having a real good buy point at this moment. They are greatly undervalued, so one should make use of it and make a good purchase. Hope you like this video, and I would really appreciate if you could hit that like and subscribe buttons and also provide your comment on what you liked about this video and what you would like to see in the future. And until we meet in the next video, Let's try as much as possible to be financially healthy. See ya. Bye.